Yeah, that's chapter 4, risk and return. Shane, look at that again, Just look at that again, 1, 2, 1, 2. All right, good? Nice? Yeah? All right, chapter 4, risk and return. You hear a lot about return. You talk about risk. It's sort of my funny way of saying and introducing this topic. Risk is more important because risk will always manifest. You're seeing risk literally. The market's down 4 or 5%, since the semester started. To me, what I find funny is that, funny means like you don't like to talk about it. It's a 4-letter word, risk there, right there, So the market is obsessed with return, and they don't like to talk about risk because literally it's something that's negative, it's unpleasant, and human psychology is such that we avoid the unpleasant. It's awkward, it's unpleasant, but like I like to think about it, if it's not said now, it will be said later and at an inconvenient time. So let's take care of risk first, because it will happen. And it will be the most influential item in your portfolio because it will be very damaging when risk happens. We're going to do basic return concepts, basic risk concepts, standalone risk, market risk, which is beta basically. Standalone risk is a risk that most people understand or think about a little bit. And then the Nobel Prize winning work, which is the CAPM, capital asset pricing model, and the security market line, which are similar terms. Here's some of the homework, but it's also, and for both the classes, the landline class and the online class, the net is, as it's there in the document, do visit the class folder. It's sort of impossible to email each one of you individually, but please make it a habit to visit the class folder. What are investment returns? Investment returns, they measure the financial results of an investment. They can be historical or prospective. So you can have an anticipated return or a realized return. So there's a big difference. So it could be expected return or historical return. Typically, there's this major slip between the proverbial cup and the lip. Is asset management firms, they know what the historical returns are. In fact, I'll calculate it in front of you. Right now, I'll update some numbers which are there from the book. The book was printed, the edited, maybe 5-10 years back. And they'll take the historical number and sort of give an impression to the client that that is the number that will happen in the future. But of course, there's, what else do you go by, But there are other methods. There's something called bootstrapping, Monte Carlo simulation. You can do some of that. But as my students, henceforth, you will see that number and you will question it at least in your mind. The returns can be expressed in dollar terms, percentage terms. Dollar terms is really old school. Percentage terms is what matters because, you can say that you had a 10,000 return on a portfolio for the year, but if you're running, a $100 million portfolio, that'll barely, pay for the electricity that's involved in running that portfolio. So we go with percentages. As you know, percentage is what matters. It's extremely elementary. Some of you will be disgusted to see this kind of information, but some of you are extremely new because I've taken a survey of all of you. And so it doesn't take much time. I'll zip through it, and that way, I'll be at peace with myself that, I've done it and you also have done it. What's the return on investment that costs $1,000 and is sold 1 year later for $1,100? So that's your dollar return right there. We all know that intuitively somehow. Percentage return, just a little bit, the difference here divided by the initial dollar investment. And so that's the total return, literally. And for stocks, and we've done the paper, which I lovingly call the big charts because that's the website that I first discovered the problem on. We did that previously, what is wrong with this picture, the Journal of Business, the Journal of Behavioral Finance 2011 paper, where if you think about it, if you invest $1,000 in, let's say, Walmart, and it pays some dividends, and then there's some price appreciation there. So your total return is the sum of your dividends that you got and the price appreciation, right? So that's your total return there. But as you know very well now, pretty much, that when you're looking at total return graphs, there are no total return graphs on the web. One or two places maybe, they only look at the price return. But you should look at the dividend return as well. It's not like you should, that's what the total return is. It's just amazing that it's omitted. What is investment risk? Typically, investment returns are not known with certainty. So investment risk pertains to the probability of earning a return less than expected. That's basically the risk. That the probability. So there's a risk. Suppose you drive. You're working at night. Let's say there's a risk the car won't start. So anytime there's uncertainty, there's risk. The greater the chance of a return far below the expected return, the greater the risk. And so, if I'm standing here, there's a risk that something could happen to us. Really, there are people who have been in a room and they don't come out of it alive. So there's a risk, but the risk is lower. But if you're walking the tightrope between two skyscrapers, the risk of a negative outcome as far as your life is concerned is much higher. So the greater the chance of an unfavorable outcome, the greater the risk is there. These are the numbers I was updating at 5:45 in the evening today. This is actually, this is the net of the chapter in a certain way. And I don't know how many times I've already said, that there's no free lunch, right? But my students remember me for that. In fact, I got an email this big on my LinkedIn from a student in 2007, and he said that he works as a financial advisor now. I'll show you no free lunch here. So we'll go through these numbers, the formula behind it. The average return standard deviation of U.S. Treasury bills since 1926 to 2001 is about 3.9% a year. Now this does not factor in inflation rate, and I think I did that in class. The inflation rate is about 2.5% for the U.S. So you got to net that out. The standard deviation is 3.2%, and so that means in a certain year, it could be 4 plus 3, 7.2%, or two standard deviations. It could be even 6% plus 4. It could be even 10%, and so there's a standard deviation around it. But you start seeing the standard deviations, which is the risk. For long-term government bonds, it's 5.7%. So these are durations less than 1 year. This is, let's say, 1 year to 30 years. Then long-term corporate bonds, 6.1%. Notice, slightly higher return you're getting. So if you invest in IBM, you invest in Lehman Brothers bonds, you expect to get a higher return. But in this case, it's interesting. It's slightly lower risk. But these numbers are calculated. But if you look at it, there'll be a slightly higher risk there. And then it shifts from bonds to stocks. Forget the return. Let's look at the risk here. 8% to 20%. What is 20% is for large company stocks. Now, if you think about it, the S&P 500 itself is a proxy for large company stocks. You have about 7,000 actively trading stocks in the US. There's an index that tracks it. It's called the Wilshire 5000. I know it's 5,000, but it's about 7,000. Then there's the Russell 3000, the top 3,000. The S&P 500 is the top 500. And that number was 12.7%. This was updated last year. It was 7.1%. That's a huge difference. This is 12.7% until 2001, the lost decade of investing, 2001 to 2012. 2013 has been a bull market now. We broke even. It's 7.1%. So a lot of investment allocations are based on thinking that equity return is about 12% a year. First thing, if you're given that information, it's not a question of questioning it or challenging it. You can say that it's not 12% anymore. if you include data after 2008, because 2008 the market was down 40%. 40% in 1 year. So that had a big impact. But look at the standard deviation. It's almost 2.5 times more. And then small company stocks are like smaller companies. Literally less than 1 billion is small company stocks. So like Apple, Apple is like $400 billion company. Smaller company stocks are like, maybe Netflix is small cap. Maybe it's medium cap actually. But companies that are emerging and so on and so forth, they actually have a high return. And that's where a lot of small investors, they get trapped in. Because they like these high return numbers, but I'll show you the implication of a 33% standard deviation. 19 out of 20 years, you have a 2 sigma event. So that's 2 times 2 sigma, that's 66%. So let's say that's 67%. 67 minus 17, that's minus 50%. So in a given 20-year period, you could have 1 year where you have a minus 50% return on that. And as you know, the mathematics of investing is stacked against the investor, right? If you lose 50%, you have to make 100% to get even, So that small cap stock that went from $12 to $6, that's a 50% negative return, which is very much possible. But then for it to get back there, is things. So this is sort of information that is based here. I just updated this. I'll show this to you. You can write this down, update it in your slides. These are 2 very solid numbers. This is like the core. What is VFINX? VFINX is one of the world's largest index funds, the S&P 500. VFINX. Its return has been 6.7% a year. VBLTX is one of the world's largest and stably managed bond fund. That's the Vanguard Bond long-term fund. They always have little, information in their alphabets there, letters. Look at that, it's right there in front of you. Actually, let me update it in front of you how I got this information. I built my own system for it because it's very hard to get these numbers unless you have professional level software. So actually this is, I just ran it, you can see, October 9th, 2013. And you see from December 31, 96. So I've got just 2 securities. I can put in more. I'll send you guys a tracker later on. I know you guys are working on it, some of you. VFINX and VBLTX. The number of stocks or positions I have is 2. Right there, 2, as you see. This is your US equity market, guys. This is your US equity market since 1996. And this is with dividends included, of course, because I've written this whole thing, I'm including dividends here. But notice, until I would say, that's 12. Until I think March of 2011, it was broke even. And then this has been the hyper move here. So when you're making your forecast for the week, think about whether you're investing for the week, for the month, and so on and so forth. This is where we are. But look at this body. And this is part of this chapter. Just by the introduction of one additional security, this now looks like this. By the inclusion of a very boring asset, B for bonds, B for boring. B for Barry bonds too, right? And James Bond. Look at this. This volatility here gets cut down. This is the 2008. This is the 2008 liquidity crisis where bonds, all assets, bonds, stocks, gold, real estate, they all took a hit. And then this move here, so nice. And the annualized returns for the aggregate portfolio is 7.4% for both of them. But notice, just notice, this is like when everybody was nicely loaded. It took the market about 7-10 years to get deprogrammed that equity is the only place to invest. And I started reading so much in the media that bonds is the place to be. And then everybody got nicely loaded up into bonds. I was getting emails from people every now and then, sometimes, hey, the bonds good time. And I'm like, I know I've been talking about bonds, but it's a little late to the party now. When everyone is in the pool, as you know, that's the time to step out of the pool. Then the blue lights come, right? You know, right? Have you done that, Officer Eric? You know, yeah. You know, we have a police officer, a military officer here. You know, so you know he breaks up the parties. You know, yeah. Oh yeah. Everyone's in the pool. So look at that. This is a pretty serious haircut here. This is a pretty serious haircut, and it's coming from the bonds actually, because bonds are down now. But you see the inclusion of just one asset. That's why I talk about the MAC portfolio. But just where this, you know, I mean, there's like many more calculations here. But here's the annualized numbers. That's where it's coming from here. So VFINX, the cumulative return is 197%. For bonds, is 229%. And in fact, this is the story of the tortoise and the hare, literally. Bonds have actually outperformed by 0.6% annually. And still, investors, and chances are maybe even you won't consider investing in bonds just because it's so deeply ingrained in our psyche that bonds don't really grow. And you know what? It's all embedded in that paper that we did last week. You're right. People are right. Bonds don't grow. Bonds are not meant to have capital appreciation. Once we do the time value of money, the bond's face value is fixed. You buy a bond, it says that after 10 years you're going to get $1,000. But what about the incremental coupon that's coming and the compounding on the compounding? It's amazing. Beta of the portfolio. So just wanted to see the beta of the portfolio of negative 0.09. All right. Risk in finance is shown by the probability distribution of returns. So on the x-axis you have the return, which is derived from the prices, okay? So if you go to Yahoo Finance, for those of you who's beginning to roll up your sleeves and do some calculation on your own, you're getting the adjusted prices from Yahoo Finance. You have to do, you know, a very simple calculation on that. You know, you have to look at the difference in the prices from 2 time periods and divide by the original price to get the return. You plot the return on the x-axis, and the y-axis you have the probability distribution. Now my favorite question to my undergrads usually is that which of these depicts a more riskier distribution of returns. Let's say the red line or the pink line. The pink one. And this shows that I'm in a graduate setting. You know, you guys have some idea of a distribution, because typically, you know, this does look riskier. I mean, especially if you're planning to ski downhill, it is a riskier slope, you know. But risk is dispersion. Just look at this, dispersion. How wide, how dispersed, you know, your returns are, you know, to the left, to the right. In this case, there is a possibility you could have a minus 20% return. But with the red one, there's a very small possibility you'll have a 0 or a less than 0% return, most of it. So this is either StockX or sort of a fixed income security, and this is probably a small cap security. This risk and return is bound together in finance by something called state of nature analysis. As financial analysts, you'll definitely be doing this. For those of you who are basically in management, you can still apply this to your work. So suppose you have different projects, in this case different stocks. You can invest in the T-bill, in a company called Alta, company called Repo, and a couple of others. And MP stands for market portfolio. Now remember, like I said, accounting and finance. You're investing with a lot of information, but that's historical. But you're investing for the future. I mean, again, just coming back, just taking from something recent, we knew that the government was going to get shut down. So it's not like it's something happened overnight. And still we could not predict what the direction of the market would be, right? We knew it, right? Imagine there's an unforeseen event that happens, macro event that happens, or something that happens to a company, you know. Then the only way sort of we can have an idea of what will happen to the return of the company is if we have an idea of what will happen to the company. But in this example I'm showing you, we knew what would happen to the economy, the government shutdown, but we still could not have the return. So if you notice, like there are two items there, you know, that are linked. I mean, the bar is even higher. Even after knowing what the event is going to be, you still don't know what the return will be, which is interesting. So as risk managers, what do? You say, well, I think there will be 5 states in the future. So having gotten that out of the way, how do you approach this? Well, the economy is going to be either in recession, or it's going to be just an average economy, or we're going to have boom times. And then something in between. See, now you're putting in your future vision glasses here, your crystal ball. Then next thing is, what's going to be the probability state for this? Well, the average state is 40%. There's 40% chance next year is going to be an average year. There's a 10% chance going to be recession, a 10% chance boom, and everything in between. What is the return going to be on the treasury? The return on the treasury is going to be constant because of risk-free investment. Right? That's why it's called fixed income. It's going to be 8%. The total return is going to be 8%. Well, for these companies, now things get a little interesting. For a company called Alta, it's minus 22. During recession times, the returns are minus 22%. During boom times, it's really good, 50%. For a company called Repo, during recession it's plus 28%, and during boom times it's minus 20%. So let's say, think of Repo as a company that repossesses, you know, electronics or items that people have bought on credit but they can no longer pay. So if the times are bad, they're defaulting on their loans. So the companies are calling, the automobile company is calling this repo company and saying that, hey, you know what, we need to have this car repossessed. And so their business is booming basically. Their phone is, is ringing off the hook. Their returns 28%. During boom times, not many people are defaulting. They don't have good returns. And think of Alta that maybe as a company, you know, that organizes, you know, nice vacations to tropical islands. So during boom times, you know, people have disposable income and they would like to go on vacation. During recession, you know, the phone is not ringing on the hook. The market returns minus 13%, 43% here. Notice, word of caution even here. You start seeing, you know, why I really abstract from focusing 2 things. As you know, I'm forecasting 2 things. You know, can't forecast life, can't forecast the market. These numbers are also hypothetical. Don't run to the bank with these numbers. These are the analyst's estimates of what the return will be on a market during recession times, what the return on the market will be during boom times. Did you guys sort of notice that? This is all future, guys. This is future. You're sitting here today, and theoretically you can just punch in any number you want. But of course you won't do that. You're going to go to the Bureau of Labor Statistics, get some data from there. You know, you're going to go, you know, maybe run my program, make your own program, go to Yahoo Finance, download some numbers, see what the average return, like Sean asked, like during, you know, you can like slice it and dice it. You can say, hey, during the last few shutdowns, what was the average return? So you can just literally go and say, during the last few recessions, what was the average return on the marketplace? And you can say, CETA is minus 13%. During boom times, plus 43. Once you do that, this is like your base information set. Then let's run with it. What is unique about the T-bill return? Like I said, I already said that, it's 8% regardless. It's nominal returns. You've already done a little bit of, interest rate formation. It's a nominal return, not adjusted for the IP, the inflation premium. Mentioned that Alta repo, one is called positively correlated, the other is negative correlation. One is counter-cyclical to the economy. See, this looks like a formula and all that, guys. Really, this is really not math, okay? I mean, in finance, economics, they use a lot of notation, but yeah, you can call it math. You can invoke an Excel function, it'll just do it just like that. So calculate the expected return of each alternative. So basically, it's sigma Ri Pi. So Ri is the return in the ith state, Pi is the probability of that state, and then you run it I equals 1 to n, so you run a counter there. So for Alta is 0.1 times negative 0.22 plus 0.2 times negative 2. And if you remember, Alta was a stock that did well during boom times. So the return is 50%. And the probability of a boom time is 0.10. You do that in Excel, you can invoke a function called sum product. Instead of going and multiplying each one of them, you can do a sum product of two arrays, and you get 17.4%. No big deal, really, no big deal. Everybody okay with, sigma? So sigma is basically a summation sign, sigma xi. So it's like x1 plus x2 plus x3. If I equals 1 to 3, that's sigma. The multiplication equivalent of that is pi, actually. So if it would be pi I, then it would be x1 times x2 times x3. It's just a simpler notation. And this is sort of like interesting homework. You can verify. As you know, can't do all of this in class. I mean, my idea is to do 35 slides today on slide 12. Alta is 17%, market 15%, and the others are so on and so forth. Repo men, just remember 1.7%. This is pretty much where the information set stops for the retail investor. We presented with this information, and here's the question. Alta has the highest rate of return. Does that make it the best? So you as an investor, which one you should invest in? Should you invest in repo man or T-bills or Alta or the market? You should not answer the question. You say, Pank, I don't have enough information to give you an informed answer. If you force me to, I'll give you an answer, but then that would not be the correct answer. Or at least it would not be an informed answer. The correct answer is, that's a whole different thing. It's like, as they say, I'd rather be lucky than smart. So you could pick any one of them, and if it works out like that, great. But then, as you know, there are always two things that blow up in a portfolio. Just remember, there are always two things that blow up in a portfolio. So what is missing, folks, is we have an idea of the return. What we just did is we have an idea of the return that is expected to each of those assets the next year. Now, however, what we can say, irrespective of the state of the market, we factor that in. So we can't keep talking about it. Not like that, but it's like recession, boom times, all of that is built in now. That's our number, net. But we don't know the variability yet. What is the standard deviation of returns for each alternative? Standard deviation is denoted by the sigma sign. Sigma, the square root of variance, so that's this. And there are a couple of formulations for variance. One of them is the probability version, where it's the return in the ith state minus the average return squared times the probability. And then you sum that up. Sometimes people wonder, why do you have to square it? You basically square it because it's difficult, and I'm using the word difficult, to take the square root of a negative number, right? What is the square root of minus 16? The square root of 16? 4, right? Well, actually it's plus 4 or minus 4, right? But square root of minus 16 is not a number It's not a real number. There is an imaginary number. I think a few of you, it's like 4i, where I is under root minus 1, But, so we want to abstract from that, so that's why we square it up, as simple as that. And all of these are formulas, and as you know, I don't want, not only do I not expect, but I don't want anybody to memorize a formula. I mean, in this day and age, information is really on your fingertips. How they're teaching medicine in medical schools has changed. But a doctor, she can just look up, she just type in a few things. They can look up, some patient symptoms. They'll have 5 papers published in the New England Journal of Medicine right there, So things are changing, and I'm most likely not in sync with what's happening, but I try to, and definitely don't want you to memorize a formula sheet. I don't foresee a situation where you'll be working and your boss will say that, hey, can you go and do that standard deviation calculation, but hey, can't look at the book, right? But you should know where to look and what to look for, more important. Another view of standard deviation is basically, this is the probability-free version, because all states are assumed equally likely. And there are a couple of changes here, folks. One is you don't see the pi here. Let's go back here as the probability here. And you still are looking at the deviation. So standard deviation is basically around the average. And so you have the average value here. And then there's a little adjustment that the stat guys, they just love, and it throws off all the other mortals, it just confuses them, but the stat guys love it, I don't know why I'm looking at Sean there. N minus 1 is basically an adjustment for degree of freedom, because 1 degree of freedom has been lost because you're estimating one of the parameters for the calculation from that sample itself. So this is already, the sample is reflecting in here, so it's N minus 1. And N is your number of observations that are used for these calculations. So just that. And your friendly Texas Instruments calculator has both versions in it. The population standard deviation and the sample standard deviation. So let's calculate the standard deviation for alta. Now this looks a little bit more intricate. The only intricacy here is you just square the deviation of the return in the ith state and you multiply it by the probability here. So it gets a little what I call this tedious, minus 22 minus 17 squared times 0.1. And then so here are your probabilities. And then you take the square root, as you know, you can do to the power 1.5 as square root, and that's 20%. Homework, make sure you know that these numbers are what's written here. This one, you can save time, but it may be good to check, but I can do it right real fast here. Why is the standard deviation of T-bills? See, now you start, gradually I'm going to put in your mind the association between standard deviation and risk. So something that's sort of a verbal concept you see in a very numerical way. 0. There's no standard deviation. Why? What do you think will be the number here? What number should we use here? Minus? Very good. That's it. The average expected return on the T-bill is 8% throughout. In any given year, whether it's a recession or boom times, it's 8. So 8 minus 8 is 0. And then, there's not, further need to do additional calculations. So that's 0 variation, which is basically riskless. Right there. So this is always an interesting question for those of you who sometimes want to think about CFA or something. I mean, this student who wrote to me, he sort of struggled in the class a little bit. It's very interesting, the students who write back to me and then they actually become, so I call them, if I may say, I convert them, without trying to convert anybody, I'm converting them, Yeah. And I mentioned 2 things. I said, if you want to do more in this area, there are 2 union tickets. One is CFA and the other is CFP, CFP Certified Financial Planner. So this student wrote to me that he is now taking the first level of the CFP. He's cleared some series examinations, and sometimes as part of it, is you do student advising, and then I talk to a student. A student comes, I say, hey, you want to talk about a job or a career? And it's fine. I can talk about either. But if you're looking at developing and establishing the basis of a career, That's a multi-year activity, you know. So this student took my class in 2007, graduated in 2008. And the poor guy's been, I was just reading. You can go look on LinkedIn, you know. It's just, the guy's been busy. I mean, that's what he's been doing. He's joined an intern at a company, the finance company, and taken the Series 5, Series 7. Now he's a certified asset allocator, and so on and so forth. So it takes time. It takes time to build a career. And what was the tangent there? Well, the tangent was here. On an exam like that, on one of these exams of the CFA, CFP, or something like that, you could actually get a question that what does a probability distribution that is just a vertical line, what does that indicate? Is that the probability distribution of a very risky asset or a risk-free asset? And the answer is the probability distribution of a risk-free asset, which is 8% in this case. That means come what state may be, there is literally no deviation in your return. There's the probability of 1 that you will get 8%. But even there, you know, now I'm sort of like, I don't know if you noticed, there was just a minor pause, you know. There was a minor pause because the credit rating of our country, the United States, is no longer AAA. So there is the smallest risk is there of the country defaulting. And for those of us who may dismiss that, it has happened in the past. It has happened to not just little countries, but huge countries. We're talking Argentina, we're talking Turkey, we're talking Deutschland before World War II, you know, which was the basis, sort of the basis of World War II, you know. I mean, to buy a small item, you literally have a suitcase of Deutschmarks there. So those are, you know, as Karl Marx said, you know, the history of class struggle is the history of economic struggle. If the economics starts shaking a lot, it'll eventually result in class and social conflict. And we do have an ideological divide, you know, in the nation. I mean, it's a little bit less now, last 2-3 years, but it was a little bit more. But anyway, guys, what you see here is the probability distribution, and you're beginning to see that the average returns are here, and then the dispersion of returns. And the blue line is alta, which has a higher standard deviation. I'm literally mapping. You'll see that I actually like pictures. I'll put colors there, you know, but you have to know the numbers. That's why I say successful investing is a blend of rigorous science and beautiful art in that order. You cannot switch the order, you know. You cannot just say that, hey, it's just art or just science. In fact, my new thing is, as I said, that successful investing is actually a philosophy, you know, an ideology almost. Anyway, to recap here, the standard deviation, it measures the standalone risk of an investment. The larger the standard deviation, the higher the probability that returns will be below, and the expected return. So now which investment should you go with? Well, yeah. So now we have extracted 2 pieces of information from that state of nature table. We had these falling alternatives that we could invest in. Of course, as you know, with all the information that I am sort of bringing to your table, you know, I don't look at any of these, you know. What would I look at here? I would have different ETFs here, you know. If you want to do cherry picking and selection, you know, I'd have different ETFs. The market is automatically assumed to be the US market. Well, you could have the emerging markets, you could have the European markets, you could have the East European markets, you could have what's called the frontier economies now, you know. I mean, these are like really developing countries. I mean, really developing countries where there's a lot of extraction of basic materials going on. And we have these 2 processed columns of information which were not there. This is what you as an analyst is going to get paid for. So a quant in finance is not an IT person, not a computer person, not a political science person, not an economist, you know, not an accountant. You know, it's a combination of all of those. And it's sort of like they're adding intelligence to data. You're not a data administrator either. You don't want to be cast as that. I mean, it's fine if you want to do that, that's fine. But then you may take a pay cut there. So you're adding some information, right? These pieces were not there. You just did something, then you got this. So you got expected return, and now you got risk here. So the question is, which one is sort of appears to be a better investment going forward? Once again, I would not answer that question. To answer that question, I would say that, Pank, you know what, why don't we normalize these two? Why don't we put these two together? It's sort of like, you know, it's sort of like, I don't know, we say that, yeah. Let's try to come up with a real example here. So let's say like horsepower, you know, so you have like two vehicles, you know. You have two vehicles. How would you compare a motorcycle with a Hummer? So, you know, one has more horsepower than the other, obviously, you know. But then, you know, how much does it have per unit? And then you look at the weight there, you look at the horsepower, you look at the mileage, and you can sort of combine the two. So here, let me do an English translation here first. I call it the pain to gain ratio. This is my, yeah. The finest term is standardized risk. You want to look at risk per unit of return. How lean is that process? I could suggest to you that I'll make you $100 million, you know. I'll make you $100 million if you give me. There's a chance that if you give me $1,000 a month or $5,000 a month, you know, I'll give you $100. There's a chance I'll give you $100 million at the end of the year. Well, what's your investment strategy, Pank? Well, I'm going to be buying the big lotto tickets, you know, with your money. And you know, if you win it, you can give me 1% commission. How much skin do I have in the game? Very little, right? You're taking the whole risk. The point is, high return, higher expected return can be promised if the investor is taking extremely high amounts of risk. You want to look at what your return is per unit of risk. In this case, we are seeing risk per unit of return. So here's standard deviation divided by return. Very simple calculation. Sort of like something linked to that is something called the Sharpe Ratio, which I can mention, I can talk about, you know, but it's nothing very complex. But William Sharpe got a Nobel Prize, and he came up with a way of comparing different mutual funds, and there's a change in improvement in that information ratio. But anyway, we'll hold on that. So that's the pain to gain ratio. You know, how much pain per unit of gain, and do you want more? Do you want less? You obviously want to minimize that. You want minimum amount of pain per unit of gain. So should you take investment with the lowest coefficient of variation or the highest coefficient of variation? And once again, the answer is a qualified answer. Smaller CV is generally better. So now we are doing a little bit of what I just said, adding a little bit of information, not actually information. Information is there. We are adding some intelligence or some analytics to base data set there. So the coefficient of variation of T-bills is 0. For Alta, it's 20 divided by 17. For Repo Man, it's 13 divided by 1.7, and so on and so forth. Everybody sort of okay with this? We have standard deviation here in the numerator, and we have return in the denominator. 1.1, 7.9, 1.4. Notice for Repo Man, you know, the standard deviation here is lower than for Alta. So if you're sort of risk averse, you may think that is the better investment, that this is a better investment because it's less risky than this. Agreed, you know. If the markets are really bad, the economy is bad, it will actually generate a positive return. But once you average out all the effects, the bang for the buck, if you want to translate it like that, is not there. The expected return is 1.7%, and leading to a very high coefficient of return, of variation, and it's basically 7.9 units of pain per unit of gain you're taking here. 7.9 units of pain per unit of gain, which is too high a trade-off. By the way, I'm seeing a note here. 4 or 5 years ago, a student asked me if you can average these. So suppose you have a portfolio of these 5, 6 assets. And we'll approach it a little bit, but it's not in the book, but I'm mentioning it. You cannot average CVs just because of how the algebra is set up. Because the CV has the standard deviation, and basically just remember, guys, you cannot average standard deviations because there's a square term into it. So CV has sigma in the numerator. So for the reason above, it's the weighted average of individual standard deviations. You can only take if the correlation between the two is 1. If not, you cannot take it. So basically, you cannot calculate the average CV of a portfolio based on the individual CVs. Another guy got a Nobel Prize for cracking that, actually, Harry Markowitz. Give you a little flavor of that. So it's simple, and my objective is to make it simple and intuitive, because we're taking a foundations class in finance. Now we got 3 nice columns here, which were not existing earlier. From a state of nature table, we have the expected return, risk, and the coefficient of variation. And now we're talking a little bit. You can make an informed assessment. There's a little subtlety I wanted to introduce here, is you can actually have 2 assets with the same dispersion. Notice, A and B obviously have the same dispersion, but they are shifted slightly. The standard deviation of A and B is the same, but which one is a riskier asset? Well, just looking at it, you can say that A is the riskier asset because there's a probability that you could have a significant negative return, whereas B, even during bad times, you're still in the positive space. The coefficient of variation of A is higher than of B. So a lot of finance is non-intuitive. Sometimes I have to pause to think about it. This A, why do you think the coefficient of variation of A is higher than of B? The average, see, the dispersion is the same, so the numerator is the same, but the denominator is smaller, exactly. The denominator will lie right around here versus here. Hence, B is a better investment. Now we can plot all this, and this can get interesting. See, these are little things now. Now we're talking, guys. All of you here in the class and out there online there. When I said there's this whole section for your final project, binding in elements of what we are seeing in the 651 class with your portfolio report. Now, do you think you can make a picture like this for your portfolio? Here are the assets that you have selected, the standard deviation of those assets, the return of the assets, let's say from September 18 till November 30th, and you can plot them. And then you can add another layer to it. You can say, hey, bank, that was like with perfect hindsight. When I was selecting these, I should have made this picture when I was selecting it. But of course, I didn't expect you to do this on September 18, right? I mean, how could I have said all of this in that first day? But really, if you were doing this in the real world, you would actually do something like this. You would look at the risk-return trade-off of the securities that you're looking at, or you would have a certain department that would look at those for you and supply you with the report, and you would have meetings with them. And there's the tussle. Suppose you are a fundamental analyst. Fundamental analyst, you're very excited. You're very excited about the new, just being funny, about the new BlackBerry. You got a Raspberry. And you're like, no, we should really buy this. We should buy RIM. They're going to come back, And then you as a quant person, you produce a report, you say, hey, the risk return is really not working there, You can take that risk. It's a lottery ticket, basically. Do you have it built into your portfolio management plan that you want to expose your investors to that kind of speculation? And there you have that. And so wherever the slope is maximized, you can have a slope line here, and wherever the slope becomes tangential is actually the asset which actually gives you the highest amount of return per unit of risk. Return per unit of risk, which is why I have the inversion here. The return is now on the y-axis, the risk on the x-axis. That's why you have inverted 1 over CV, which is the basis of the Sharpe ratio. People are doing it. Yours truly is doing that. So as you know, or maybe you don't know, I have this website. I have a few websites actually, but this one I built in 2012. Well, it takes so much time to go there. No internet. Wow, that's really slow. So if you go there, just go to the quant site. I built a sub-quant site here. See, now it's loading up quickly. See, download the cap and beta, correlation and risk file for the top 200 ETFs. So I wrote a program, first got the top 200 ETFs, then I calculate all these. This is just for the Dow 30. And then there's a liquidity paper, you'll see as you get deeper into it. You will need to know what the liquidity is of the assets you're investing in. You basically don't want to invest in a non-liquid asset. I mean, really, that's a disaster for your portfolio. So let's just do this here. Let's make it Dow 30, so that it doesn't look that busy. Oh no, this is, yeah. So here are some of the metrics here. I will post a file that will look like this, which will have the betas for all of your individual securities. But here's your Sharpe ratio, here's your 1 over CV. Here's the annual standard deviation, annual total returns, correlation with the S&P 500. So you can see, actually the other one is, it'll give you a different feel for it. Yeah, right here. So here's your S&P 500. So here's your S&P 500. So the Sharpe ratio or 1 over CV, risk return, higher is better here. So if you remember, the financial sector has been basically in the news since 2008. And look at that, the risk return ratio is negative. Anytime, and then I automatically wrote, a little bit of script to color code it. Anything that's red is obviously not good. So you see all these negative coefficient of variations here, or inverted here. And then for the positives, it'll probably go and hit some of the bonds here. See right here, look at that, gold, 1.2. Again, gold, 1.2. That's a different ETF. What do you think is this Ultra Pro? This is like an inverse S&P 500. So while the market was going down, this ETF was doing good because that's the inverse. There should be some green. I'm looking for green. Right there is green, guys. So here are the bonds. Now remember, this was done last year. So all of this was looking good. Now this is like real finance I'm talking to you about. Suppose I was an asset manager or an advisor. I would have this information, or at least I should. And I present this is looking good. But here's the point. Something that's looking good, then it's going to start looking bad. Because if somebody can calculate it, a lot of people won't even know. But even if some people can calculate it, it's still in the realm of the mainstream. It's called efficient markets. If I know it, it's too late. Even if I have a way of processing it. All of this was looking good. This was the information that even the big asset managers were having. And so people were loading up on bonds and all that. Now see what happened to bonds. This picture was the inverse in 2000. So that's a very important piece of information I'm saying that, and this is, you've heard of it, but nobody pays attention to it, is the past is not is indicative of the future. But nobody, they just think it's called stationarity. And I had a couple of students in my office talking about the beta of the portfolio. People think that returns are stationary. No, they're not. They really are not. And look at that here. You can get all this, so much more. It's all free. You don't have to log in, sign up, nothing. By the way, here are the expense ratios. You will need this information. I suggest you use the latest one from different websites. You can go to Yahoo Finance. But look at that. So you have FXI, which is an ETF for China. It's pretty expensive, 0.72% per year, which is still not bad. I mean, mutual funds are much, much higher. Natural gas ETF, 0.96. So here's the expense ratio. By the way, do you think that I typed in these numbers by hand? No. No, you just do scripting and all that, It's actually based on, if I can see it on a website, I've written a program, I can download it in a machine-readable format. And I published it. 2006, Managerial Finance, Automation Algorithm. Is it part of your paper? It is, but it's not required reading. Yeah. It's simple stuff, actually. But it's simple now. At that time, nobody was doing it. In fact, Microsoft actually had applied for a patent to download one ticker at a time. I actually extended that. I can put in a whole list of tickers there, and it'll just strip the whole thing down. And it's not hacking. I'm not hacking or anything, okay? If it's there on a public website, is that okay? Can I grab it? If it's on a public website, you can write it down by hand, right? All I'm doing is I'm running a program on it. But that is fun. And then see here, look at that. Here's the liquidity. See, I mean, this is actually how I would like to, if I may say, teach finance, to actually show it, So here's liquidity right here, guys. This is traded volume. 123 million shares traded on average a day. There it is, the granddaddy of all ETFs. Next highest traded, XLF, EEM. All our finance books, it's all market. Market is US. Where's US money going? EEM. What do you think is EEM? Anybody? I love it. Great. IWM. Where's the market going? The smart money in the US goes to small cap stocks. My professor, back from 1991 when I came, he sends me jokes nowadays that I can't send you guys. He used to say to me, I remember, and I imagine this 24-year-old coming from him. He said, Pankaj, I want this yesterday. He'd give me some work to do, I want this yesterday. And I say, all right, sure. He said, and if you don't get it to me, what would he say? Yeah. Oh, I can't say. Just forget. Yeah, and I'm the lawnmower. He said something here, grass, you are grass, and I'm the lawnmower, basically. Something along those lines. You can fill in the blank. But look at this here, guys. There's natural gas there. That's your EFA. That's Western Europe, Japan. That's the volatility index. That's emerging markets, XLI, industrials, energy, and so on and so forth. So here's a nice list, actually. Highly processed. I get a lot of hits on that page. People just download it. Boom. There's a lot. What's the correlation? If you're investing in SPY and you invest in EEM at the same time, you're actually taking a lot of US market risk. Because emerging markets, they will sort of do what the US does. In fact, there's some great papers recently that cause and effect causality has reversed. This is research from the last 2 years. What did I mean? What did I say?
The US market follows more with emerging markets again.
Exactly. A little bit. It's typically, it would be like, I think what I would read and if we have a cough here, then they would sneeze, or something like that. But it's going the opposite way. Sometimes the emerging markets are leading now, especially when there's a crisis in the US. The emerging markets there, the money flows there. It's US money, actually. US money now flows to emerging markets. Emerging markets take off, and then the US market stabilizes. It's getting very interesting, guys. And you guys are literally at that cusp, of that change which is happening. I see that change happening. The other day I had an undergrad student, hardcore Mainer, if you know what I mean. And the guy says, I need to know how to transfer credit, to this Kenyan university. I want to go, I'm going to learn Swahili. I want to go to Kenya. I'm like, really? I didn't say that, but I'm like, sure, but it was hard to find the transfer equivalents there. But that's what it is. I know the son of a lobsterman, for his international studies a few years back, instead of going to UK, he went to China. Now he works for a Hong Kong firm out of Seattle. So these guys are actually, in a way, I don't want to use the word pioneers, but they're sort of ahead of the curve. Maybe a little ahead than you and me, They're doing it. And it's all reflecting in these things. It's all reflecting in this. And there's some other things that you guys, there's a lot of fun stuff here, actually. Let me see. See 4 pictures that will change your view on investing. That's Usain Bolt. I don't think he'll change your view on investing. It's